Okay, hello everybody, and welcome to Investing with IBD, sponsored by MarketSmith. Today is July 15th, 2020. I'm your host, Arusha Pierce, and today we have Kerim Derhalli on the show. Kerim worked on Wall Street for 35 years, and his last role on Wall Street was as global head of equity trading at Deutsche Bank. Now he is the founder of the Invstr app, and the Invstr app is a really cool app centered around learning how to invest in the markets. Thanks for being here, Kerim.
It's fantastic to be with you. Thanks for having me on the show.
On today's podcast, we are going to have Kerim for the first two segments, and we're going to talk about how he got started in the investment world, and then we will also talk about his cool new app, Invstr. And then for the third segment, we are going to have Mike Webster, IBD's head of market strategy, on the show. And Mike and I will talk about the current market and end the episode with three current stocks. Okay, so let's get into your history, Kerim. And why don't you walk us through how you got into investing and got up to that amazing level?
So, I mean, it wasn't altogether obvious, actually. My mother came from a family of lawyers, and she was very keen on me becoming a lawyer.
Okay.
And my father really thought I should become a doctor because he thought being a doctor was a universal skill that, I could take anywhere I want. But I'm terrible with blood, particularly my own, let alone other people's. And the thought of reading all of those books in a law library, scared the hell out of me. So, I've always had on a serious note, I've always had a fascination and a passion actually for international economics. I grew up in a very international surrounding. And so, rather than being a lawyer or a doctor, international banking is what appealed to me, and that's where I started. Straight out of university, I got a job at JP Morgan, and that was fantastic. But that's really how I got into it.
And so now, when did you get into JP Morgan?
So they recruited me out of university. I had an offer. My father worked for an oil company, and I actually applied to Shell, and they offered me a job as an oil trader. This is way back in 1983, so a long, long time ago. And they were actually paying me more money than I was going to earn in banking. But JP Morgan had the prospect of sending me off to New York to work on Wall Street, effectively get paid a really good wage at the time. It was a princely sum of $25,000 back then was a huge amount of money, and effectively to be taught an MBA by professors from Harvard, Cornell, Columbia, and NYU. So it was just an amazing experience. I was 20 years old at the time, to be a young man, earning a lot of money in New York, which is a absolutely amazing city, obviously. And it was just a great prospect. And JP Morgan is really it's a world-class organization, and back then it was, even more special, possibly, than it is today.
And so this was so at that point, PCs weren't all over the place. So when you were learning how to trade, it was more on the phones, talking to people, things like that.
So you're absolutely right. I think we got our first PC in 1985. So I started work in 1983. So it was kind of almost 2 years before we got our first PC. And up until that point, we'd get the overnight runs from the VAX machines with our, printouts, literally paper printouts of our bond positions, and we'd scribble notes on them. I had a bond calculator. I was trading bonds in those days, and I had a bond calculator to work out my, my bond yields, and an HP12C as well. Wow. So everything was done manually. The other thing, back then, trading, particularly in the Eurobond markets in London, was a head-to-head trading competition. So you were making markets to other professionals, and you had to be very, very quick to move from one, to get liquidity from the different banks. So the competitive advantage was really in the number of phone lines that you had with the other banks.
Wow, that's I mean, there's always some kind of technological advantage out there, right? Now, right, this absolutely. Was also during the time when hedge funds started to come about, and really you were coming in at a time where the whole financial system was starting to dramatically change too. What did you see during this time?
Look, it was an absolutely fascinating time to be involved in financial services. Between 1983 and 2008, financial services went through an absolutely remarkable evolution. As you mentioned, we had the growth of the hedge fund industry. We had deregulation. We had a massive increase in trading volumes. We had huge product innovation, and we had tremendous geographical expansion as well, all around the world. So it was an absolutely fascinating time to be involved in financial markets.
And so now I would imagine that just being at JP Morgan, that also enabled you to go and travel the world and be able to go and take a look at other markets around the globe.
Yeah, look, I was very, very lucky. I'd grown up obviously in Europe and the Middle East, and with JP Morgan, I got to live and work in New York. They sent me first off to Japan. So I was in Japan right at the peak in 1989. Nikkei was at 38,000. So it was a fascinating time to be in Japan. I also got to go and live in Singapore. I was in Singapore in 1990 and then back to New York. And so I got to live and work all over the world. And subsequently, in the roles that I had later, I was global head of commodities, global head of emerging markets, global head of equity trading. I got to travel, to Latin America, to Asia, really all over the Eastern Europe, all over the world. So the cultural exposure that I got was absolutely tremendous.
And you also had an opportunity to participate in the Russian debt crisis too, right? When was that? That was like in the late 90s?
So that was in 1998.
Okay.
Really, really interesting episode. I guess I got involved in Russia starting in about 1994. Interest rates were 1,000%, and it really was not quite the Wild West, but the Wild East. When I first went to Moscow, there were no neon signs anywhere. It was really very, very unspoilt at some level, very unspoiled, very undeveloped. And it's really quite remarkable the evolution that Russia went through after that. So we got heavily involved. I was probably one of the pioneers in the Russian markets. Got involved in Russia in the early days, negotiated with the central bank, the Ministry of Finance. There was a fantastic deal in early 96 when President Yeltsin was trying to persuade, he was up for election, and he was trying to persuade the domestic electorate that he was quite popular in the West. So he actually mandated Merrill Lynch to raise $6 billion for him. And so we had this tremendous mandate. We worked with the Prime Minister's office.
Wow.
And did some fantastic things. And so we were really quite well positioned in Russia all the way up until the crisis in 98 and the default in August 98. Now, fortunately, because we were well connected, I got to see the crisis coming, and so we were really well positioned. Unlike many of our competitors at the time, I was at Lehman Brothers, and we were really well positioned to see the crisis. And so we actually went into the crisis actually short Russian credit, which worked out really well. But we had a massive book. We were about 10% of the Russian market. We had billions of dollars worth of bonds on our books and huge exposures to the Russian banking system. And unfortunately, in unwinding some of those exposures, we ended up closing down 3 of the Russian banks. And closing down a Russian bank is not something that you do advisedly. We had threats. Actually, I had to stay out of Moscow for quite some period of time. And I also made the mistake of putting the Russian government into default. We got some rather angry calls from them. We had to reverse that. So it was an absolutely fascinating period of time. But because we were so heavily exposed in the Russian markets, the Russian government asked me to be involved in their so-called debt advisory committee, which was really just a creditors committee. And that was an absolutely fascinating time. A few years prior, I'd been pleading with them to allow foreign capital into Russia. And now I found myself in the exact opposite position of trying to plead with them and negotiate to get capital out of the country.
Wow.
It was an absolutely fascinating experience, that the debt renegotiations, late 98, 99, in the end, we made a small fortune out of it, because domestic interest rates at the time I was trading, government bonds, domestic interest rates were around 250%. And I managed to persuade all of our other creditors that if we were going to be stuck in Russia, because the Russians weren't going to make it easy for us to take our money out of the country. So if we were going to be stuck in Russia, we'd rather have ruble debt at 250% than some inferior subordinated dollar bond with a much lower yield. So we restructured the Russian debt in rubles into new ruble bonds. And then I got massively long the yield curve, bought all these bonds at 250%, yields collapsed, and we made, I think back in 99, we made about $300 million, which, even today is a decent amount of money. Back then it was a huge amount of money. Yeah. And in the first 3 months of 2000, made an additional $200 million. So it was a fascinating experience at a professional level going through the crisis. It was also a fascinating experience at a personal level. I mean, I was a lot younger back then, obviously 22 years younger, and I'm not sure I would have been quite as brave with some of the decisions and quite as brazen in terms of taking on the Russian banks and the Russian government and various other power structures within Russia, including some security services. So we got into some interesting situations, and I was warned off quite a few times, but carried on going, and really enjoyed the experience. I've been back involved in Russia since. It's a absolutely fascinating country, fantastic people, incredibly well educated people, incredible cultural, music, scientific history, but really quite an eye-opening experience for a young man in the financial markets. And that really gave me a great a feel for enjoyment, appreciation of emerging markets. I mean, it wasn't just Russia. I mean, obviously the other markets we were involved in were throughout Eastern Europe. The new Poland, Czech, Slovak, Hungary, Turkey, Romania, Bulgaria, South Africa. All these markets were emerging from the post-communist period, and to see the transformation at first hand, not just in the capital markets, but even at a human level, in societal level, and the way the economies evolved was really frankly it was a privilege to be involved in those markets. And later on in my career, when I was involved in commodities, obviously there are a lot of commodities in emerging markets. I managed to go back to many of those countries, obviously got then more involved, not just in Eastern Europe, but in Asia as well, and in Latin America as well. So I've been very, very lucky in terms of the banking experience I've had, but the cultural experiences I've had as well. If you think about it from a market point of view, I mean, it'll shock you. When I started work in 1983, the S&P was at 135. So it was. I mean, I wish. Obviously, hindsight is an astonishing thing. We've rallied 25-fold, since then. And interest rates, I think 10-year bonds were somewhere around 14%. And so you think about, what's happened in the world since then. I mean, just the incredible growth in financial markets and also in financial asset prices. It's been an absolutely astonishing journey. I'm very, very privileged to have experienced it all.
And during this time, what did just your experience in investing? What did that teach you about emotions in investing? Because one thing that a lot of when I went through my finance courses and things like that, and learning from a lot of professors, is we were always taught about efficient markets and things like that. What did the real life experience, especially in these really dramatic changes and volatile markets, what did that teach you about emotions and efficient markets?
It's quite interesting. I studied economics at university. I was at Oxford and studied economics, and you learn, one of the first things you learn is about demand and supply curves, and the demand is high when the price is low, and supply is is low, when the price is low. And so you draw these demand and supply curves. And what I would do with new students joining, I remember particularly at JP Morgan, I would draw these classic charts for them. And then I would scribble out the S and the D and reverse them. Because what you learn about markets is that when prices go up, demand doesn't fall, demand increases. And when prices go down, demand doesn't increase, demand decreases. So humans operate in exactly the opposite way to what a classical economist would tell you. And the nonsense about, efficient market theory, yes, markets might be efficient in the long run, but obviously, as Kane said, we're all dead in the long run. What keeps markets efficient is the interaction of buyers and sellers. So the opportunities, some of the opportunities in markets are the massive inefficiencies that exist. And that is driven not by fundamentals, but it's driven by human perceptions of fundamentals. So, why was the S&P at 2,100 just a few months ago, and why is it at 3,200 today? I mean, it's almost a 50% increase that we've had. And the world hasn't changed fundamentally. I mean, the perceptions of what is going to happen in the future have changed. So one of my lessons, I think you're spot on, Arusha, about human emotions. And one of the big lessons I have, one of my big takeaways, is that even a baby is equipped to be an investor, because fundamentally markets go up and down. And they go up and down on the back of human emotions. And babies understand up and down, and they understand from birth human emotions. And so it's one of my big beliefs that we're all naturally equipped to be investors. And because because investing at the end of the day, in financial markets at the end of the day, yes, computers are involved and all kinds of other things are involved, but fundamentally they're about people. And it's about the interaction of people and people's perceptions and people's emotions. Those are the things that really drive financial markets.
Oh, that's perfect. So let's take a quick break. But when we return, we're going to talk about how Kareem has taken this experience, as 35 years of experience in all of these different places around the world, and incorporated it into his new Invstr app. So stay tuned. I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks. Just on the U.S., I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020. Kerim Derhalli is our guest on Investing with IBD, sponsored by MarketSmith. Okay, Kareem, let's talk about your Invstr app. And so you were 35 years in Wall Street in this really exciting time, and you decided to walk away and now go really in a completely different direction towards education and really kind of giving normal people more insight on what's going on with the markets.
Right. So look, what I realized after the crisis, obviously beginning in 2008, 2009, and then 2010, is all of those wonderful trends that we'd seen that had driven wholesale financial markets so well, the deregulation and the increase in leverage, geographical expansion, product innovation, increase in volumes. Not only had they stopped, but they'd gone into reverse. And my expectation was that we were never going to see the rebirth or the resumption of those trends, certainly probably not in my lifetime. At the same time, I realized that financial markets, I just love financial markets. I've got a passion for financial markets. I think they're fantastic. They reflect everything that's going on in the world. And for me, this is almost a common good, and they've become too much of an insider's game. Mm-hmm. And what I realized with the advent of the mobile phone, of cloud computing, and in particular, the realization I had around social media and the growth of social networks was here was a technology or a group of technologies that were absolutely perfectly suited to the financial markets, because financial markets, particularly today, they're 24/7. You need to be up to date all the time. Mobile phone was perfect. As we were chatting about earlier, financial markets are all about people. Social networks are all about people. So a mobile app, with employing a social network, was the perfect solution to driving inclusion into the financial markets and exposing people to financial markets. And so that was the genesis of the idea of Invstr. And my other reflections on the whole information revolution, really starting in 1995, was kind of when I really became conscious of the public internet as a technology. Was that whole revolution that started in 95 onwards, for me, was all about one thing. It was about individual empowerment, because all of a sudden, for the first time in thousands of years, information that had been to some extent monopolized by different power structures, governments, political parties, religions, universities, banks, companies, etc., was now being democratized, and we'd moved from a world that was top down in terms of information to one that was actually bottom up in terms of information. I think that's one of the most profound changes in our human civilization that we've seen in thousands of years. And I realized that was going to spark a revolution in financial services. I think we're barely in the foothills, by the way, of that revolution. Wow. But that revolution was all going to be about the empowerment of the individual in relation to financial services. And basically, shorthand for that is self-directed investing was going to come to the fore. And so self-directed investing was going to be the big new trend in the world, in one of the largest industries in the world, second largest industry after agriculture. And here was a group of technologies that lended themselves perfectly to the exploitation of that trend.
And so it started, the information age, where now you're empowering a lot of individual investors. And then obviously in 2012 and around that time, as you mentioned, the mobile age, where now everyone has a super powerful computer right in the palm of their hands. They can stay in touch with social networking, really starting to emerge. And then you had this large group, the millennials too, who are really interested in all of those kind of aspects of getting information and also sharing it with each other.
Right. So look, what we did, right at the beginning is we went, and surveyed several thousand, 4,000 or 5,000 millennials across the US, across the UK, in every geography, in every, sub-age group. And we said to them, we asked them a number of questions. One, do you invest? And the 90% said, no, we don't invest. And then we asked them, do you want to invest? And 90% of them said, yes, we do want to invest. And then we said, well, what's stopping you from investing? And the overwhelming answer was, one, and I'm kind of paraphrasing, but lack of confidence. Mm-hmm. Two was lack of knowledge. And three was perception that you needed a lot of money to be an investor. So perceived lack of wealth to qualify you as an investor. And those were the three things that overwhelmingly came back as the problem. I think the thing I should mention is that not a single person said trading commissions are too high is the problem. And so what the fintech industry has very successfully done in the last 2 or 3 years in particular is solve a problem that really never existed. Mm-hmm. But that aside, and so my realization was the thing that is stopping people from investing was really a lack of confidence and a lack of knowledge. And what that translated into was education. That we needed to use a mobile social network to help educate people. To build sustainable financial capital, we need to help people build their human capital when it came to investing. And so
Yeah,
our focus.
And Kareem, and well, another thing is also it can be overwhelming too. I mean, if you haven't been exposed to the financial world or any finance courses when you're growing up or going through college, it can be very intimidating, and it's hard to get the motivation to get through that too, right?
Right. So you're absolutely right. I think the finance industry, which I was a part of for 30 years, did an excellent job, basically putting up keep out signs and barbed wire all around to create an illusion of complexity and to help justify the very high fees that were being charged to manage other people's money. High fees, by the way, that are being charged by people who consistently underperform the market year in, year out. I mean, the financial industry is a tax on the economic system and is a value destroyer. And that's, that's a shocking thing to say, and so really for us, it's, yes, it was too complex. So the challenge is, how do you show people that the finance industry is, and in particular, let's focus on investing actually, that investing is really simple as an action is really, really simple. You buy something, hopefully when the price is low, and you sell it when the price is a bit higher. Right. I mean, that's fundamentally what investing is about. So the transactional component of investing is really simple. And what we realized is the best way of conveying both the excitement and the simplicity was through a game. And that's one of the things that we started to develop. So we've developed at Invstr an educational platform that's really built on a number of really important pillars. The first of those is the game that we call fantasy finance. And what fantasy finance, as you say, Arusha, it helps people understand that investing is fun, that it's simple, and it also helps people to learn some of the basics of investing. That investing isn't about making dollars and cents; it's about generating a return on your capital consistently over time. Yeah. And that to do that, you need to preserve your financial capital. And the way to do that is to be diversified. And the other thing you need to do is to preserve your emotional capital. And the way to do that is to be, is not to overtrade. And, the interesting thing is that using leverage or margin and trading options actually works in exactly the wrong direction. I mean, it's the antithesis of good investing, because it destroys your financial capital and it destroys your emotional capital. And so it's something that we're quite strongly opposed to.
Yeah, and you made that conscious decision not to have options in your app, right? You have commodities, stocks, Bitcoins in there, yes. But you don't have options in there.
I think crypto has a very valid place in a portfolio. We've done some analytical studies to show the benefits of having crypto in a diversified portfolio. I mean, they're really quite staggering. So we think there is a place for crypto, but we don't think that margin and option trading are good investing techniques, particularly not for beginners, right? What we're trying to do is, the most important thing is we need to get people in the game. And you get people in the game by showing it's fun and exciting and all those other things. And in our case, social as well, because the social community that we built, which facilitates the peer-to-peer learning, is just incredibly powerful. But the second challenge is not just getting people in the game. The second challenge is keeping people in the game. And because if you can stay in the game, if you can stay as a long-term investor, then you've got all these natural forces: population growth, a little bit of inflation, productivity growth, and then the magical, sprinkling power of compounding. All of those things are working in your favor. Yep. So if you can stay in the game, then you're riding a trend, you're riding a wave, and everything else being equal, you should over time make money. And you look at the long-term returns for investing in something like the US stock market is about 10% a year, or thereabouts. So the key is to be able to stay in the game. To get in the game, absolutely, but you've also got to stay in the game. It's a marathon. It's not a sprint.
Right. One thing, Kareem, is that especially for the younger people, and you have attracted the Invstr app has attracted tons of young people, and they're using your app. But one huge advantage that young people have is they're using some of the new technology that is changing the world that people, when they're older, they might not necessarily understand.
Yeah, look, you're absolutely right. We young people are obviously earlier adopters of technology, and so it's much easier for them to navigate their way around a mobile phone and a mobile app. But actually, we have an 80-odd% of our users are and our members are millennials and Gen Z. But we have grandfathers and grandmothers and people and college professors. We have older people on the app, and they're fantastic, and we love to have them there.
Yeah.
And actually having that balance, a little bit of that balance between people who've been around a little bit longer and have experience, combining with some younger members, I think that's a fantastic combination, because there's a lot that both sides can learn. There's a really healthy exchange, that both sides can benefit from.
And then also, especially with a lot of the younger people, the stock ideas that they're going to recognize, right? Because when I was on the app and taking a look at it, I saw plenty of Tesla stuff mentioned, right, and a lot of these newer kind of companies
yes,
there, and that naturally is they see a younger person. Well, a lot of people see it, but younger people see Teslas and it's like it's so cool.
Yes, look, I think we have a one of our members is actually a super wealthy businessman, and he uses our app religiously, so much so that he has to hide from his wife when he's using it, because he complains he's on it too much. And he was saying to me that he started off by deploying all of the stocks and all of the things that he knows, and he wasn't having much success. And then he got involved in the community, and he started listening to what some of our younger members do. And all of a sudden, his fortunes turned around. He started making a lot of money. And you're absolutely right that younger investors are much more attuned to the excitement and the promise of the company like a Tesla. And in January, when everyone was desperately trying to go short Tesla, and Wall Street, I think, lost $10 or $11 billion being short,
yeah,
our community made 10% on average on Tesla, just on Tesla. And so you've almost seen, I think at some level, there's almost been a transfer of ownership. In the past, it used to be a divide between so-called smart investors and dumb investors, and dumb often meant retail.
Right.
And actually, there's now been, I think, a transfer of leadership in the market from old to young. I mean, the people driving the markets, driving the rally that we've seen all the way up, while Warren Buffett is sitting on his hands, the millennials and Gen Z are buying stocks like crazy, because all of a sudden they see there's a 40% discount on Wall Street. They've never seen it in their lives before. Stuff is cheap. Everyone tells them you need to be a long-term investor. So they piled in, and I think they were part of the reason that companies like Tesla have done so well, while the old guard have been quite resistant.
Yeah, that is actually really, really interesting. Now, talk about also just the importance of practicing. I think just getting your feet wet, but just practicing doing a bunch of trades before you actually start doing it for real.
Look, it's what we say is that learning to invest is like learning to play a sport or a musical instrument. You've got to get fit, which means you've got to read the news, follow the markets to see how they react, and then talk to people to understand why the markets reacted in that way. So that for us is how you get fit. And then you've got to practice. And what I say is you wouldn't want to go and play against Rafael Nadal for $1 million. Unless you'd practiced your serve and your volley and a few other ground strokes as well. So practicing is so important. And equally, you don't want to get on, you don't want to start on Wall Street trading against all of these supercomputers and people who've ultra sophisticated trading strategies for money, with your life savings without practicing. And what fantasy finance enables people to do is to practice in a real world environment, but in a totally safe way. And actually, what we say to people, who complain that they're losing money and it's not working, I say, you can afford to lose money in a game because it doesn't cost you anything. And in fact, you'll learn a lot more from your mistakes than you'll ever learn from your successes. When we do something well, we think it's down to our natural brilliance and genius. When we do something badly, it forces us to be a bit more introspective and to say, what did I do wrong? And so you learn from your mistakes. But you want to learn from mistakes when it's not costing you real money. So having a safe, risk-free environment to practice in, like fantasy finance, we think is super important.
Perfect. So making concepts fun and easy to learn can go a long way towards getting that motivation to learn something as complicated as the stock market. So definitely check out the Invstr app. I think it's a great way to learn and compete with your friends. Thanks for joining us today, Kareem.
It's been a real pleasure. Thanks so much for having me on the show.
Coming up next, we are going to have Mike Webster, Head of Market Strategy at IBD, on the show. So stay tuned.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
Welcome back to Investing with IBD, sponsored by MarketSmith. Now we have Mike Webster returning back to the show. Mike is the head of market strategy at IBD. And first, welcome, Mike.
Sure
it's great to have you back.
Are you sure you want me back? Isn't it supposed to be somebody?
I'm already regretting it.
Okay. Well, I
No,
feel
no
there
way,
were like
man.
7 people who canceled on you, but it's okay. I'm down the list of the Rolodex, the old Rolodex. The millennials are, what's a
You're the
Rolodex?
closer. You're the closer.
I'm the
We're bringing
closer.
the heavy hitter
Yes.
at the end. And so that's what you are, especially for these crazy markets. And it wasn't a very fun day. Well, it was a fun half day on Monday, right? We were all happy. And then the last part of Monday was not so fun.
Well, that's why we hate gap ups, is because sometimes they end like that. And we talk about it on IBD Live every time there's a gap up, we're like, oh God, no, not a gap up. Because, every once in a while we get one of those. It was a bad day.
Yeah. So let me pull up the markets and then we can take a look at it. And so I'm showing the MarketSmith charts here and the snapshot of the NASDAQ, and the market's closed right now, and we are still July 15th.
Yeah.
And so what do you okay, so here's Monday, right?
Mm-hmm.
Where we had the really strong Mike right there. So gapped up higher, everything looking great, sells off, everything falls apart.
Well, it's probably worth going to an intraday chart, just a 60-minute, just for a second, just to to refresh everyone's memory. So we come into the week, and and every time we come into the week, it's like, okay, it's time for us to take a pause. Let's just go sideways, and it doesn't happen. The market just keeps going higher and higher. So we start off with this big gap up. And at that point, you can't really fight it. You can't say, oh, I think it's going to fade. You have to just roll with what the market is giving you and say, okay, now maybe this is an inflection point and we're going to start going higher, even though you have this in the back of your mind, because, and you should, anytime you have a gap up, think, okay, what if we fade here and start rolling, it's going to look a lot worse than just having a down day. And so anyways, yeah, and you see the way, and that's why I wanted to do the intraday chart. I mean, we didn't come down gradually. Like, it's nice to come down like a stair stepping down, but this is that elevator down. And the old saying of you take the stairs up and take the elevator down. And that's exactly what we had happen there. And if you look at the distance between the 9663, if you can point to that, which was the last time we tested the 21-day, just a little bit, 9663.61. You see it?
No, I don't. It's over here.
It's right there. It's okay. I'm like willing.
It's been a long day.
Those are not the droids you want. Okay, anyways. So that was the last time we tested, and then we ripped up to the high on Monday. And so at that point, your expectation is that you can give back about half that distance. So that's what we call a 50% retracement, just standard, way you look at charts. And that's pretty much what happened there with that low of the 10182. And now we're bouncing up from there. So let's go back to the daily now that we kind of have this mess in our head of what happened there. So when you get that type of washout, you go way up and you come way down, the logical thing is to put some time in sideways. Now, that's been the logical since March 23rd to go sideways, but we've just been going pretty much straight up with these violent moves down. So far, the character of the market hasn't changed, and you can tell that by every time it dips down and hits the 21-day, which on your charts is that purplish pink line there, and it comes down, it'll undercut it or almost undercut it, and then bounce up. And so that's what we're having now. But it does seem with that overhead from Monday that we should go sideways here. But there's a real disconnect between this chart, the NASDAQ, which is, heavy into Apple, Microsoft, Amazon, Google, all those names, versus the S&P 500, which is more broad-based. And so let's look there. And let's look at the weekly real quick. So this one, you can see it's almost like a completely different market, environment. We had the Corona bear market, and we've come up, and you could look at this as a little flat base that is formed, or the way I'm looking at it is a cup with handle, and we're in the handle area. So as we're breaking out right now, that's really constructive, because when you break out of a base on a pattern on the indices, you can have a nice big move up the same way you do with stocks. It doesn't mean it's going to work out, but that's the setup. So let's go to the daily, which this is really encouraging, and it's really kind of just a rotation out of the big cap, mega cap tech stocks that have been leading this move. And it's logical, because you're still going to use Microsoft and you're still going to use Apple even if you're stuck at home, versus so many of the other things like the cruises and the anything travel related, and there's so many even a lot of the restaurants and things. So now we've moved up, and the good thing about the S&P is now we have the 50-day, which is that red line, has moved through the 200-day, which is the black line. And that's significant, because a lot of big players and big algos will use that as a general, is the gas on or is the gas not on? Are you pressing down? And now that we're above that, it's referred to as a golden cross. That's a positive thing, and we're right at the high of that handle area. So to me, this looks like we're going to launch and go higher, which is kind of a disconnect with the NASDAQ, because you look at the NASDAQ and it feels like it needs to pause. Then you kind of look at a few other indices just to get a sense. So let's look at the IWM, which is the small cap, which is for the Russell 2000. And let's look at the weekly on this one, because this has really been a dog for a long time. And you can see with that relative strength line. In fact, let's toggle over to the monthly for a sec. And you can see this is a dog. I mean, it never leads for anything other than like maybe a month at a time. But it is finally, let's go back to the daily chart. So it's finally made it back above the 200-day. So that's significant, and it tried it a month ago, and it failed. And you can see when it failed, it like really failed and gapped down dramatically. And so we need this to get over that 153.39, which would be the handle on this one. You can see that it's kind of over the prior resistance area. And the reason why I bring these up is because you just want a more broad-based bull market. You just don't want Amazon and Netflix and all the other ones to have to just lift everything. Now they can. There's nothing saying that the mega caps can't lead everything, but I think from a comfort level, you would like these other ones to at least get up to old highs over the next several months, hopefully by the end of the year.
Yep. Yeah. I mean, the broad-based rally is always a much better rally, because now everyone's making money and no one wants to leave the party at that point. But so it is interesting that you're seeing this potential rotation.
Yeah, and as long as you have Powell, doing exactly what he's doing, which is great. He's got the punch bowl out there. He's got a bottle of Tito's. He's pouring it in there. He's getting everybody happy, right? And as long as he doesn't run out, so you need to make sure you go to Costco, load up, get him some Tito's, pour it in there, keep everyone happy. But one day, that'll dry up, and then there'll be something to pay. But hopefully that's not for a long time, because there's all this uncertainty out there. And the reason why he's being so loose and actually doing everything right is because, for a few days, the news flow is very positive, and then all of a sudden something negative happens, and he's smart enough to be aware that he needs to keep that spigot going and be loose and keep interest rates low, because there is all that uncertainty out there, and the travel, things are just not going to be back to normal for some time.
No, it doesn't seem like it. So the market still is officially in an uptrend, and so you got to respect that trend and manage your positions accordingly, right? So
let's
that's
talk
the
back over to the Nasdaq one last for just 1 second. For what people should look for is just that 21-day. As long as we're still trending above that, this character hasn't changed. Now, at some point, we're going to have to test that and have an intermediate correction, and you want that to happen, because during that time frame, stocks are going to form bases, and then the weak ones will just kind of start rolling over and not coming back, and the strong ones will form bases and then give you another opportunity. So when that happens, that's the time to do your homework, and so don't be afraid of it.
Perfect. Okay, so let's go into some current stocks, Mike. And the first one that we have on the list is Intuitive Surgical, ticker symbol ISRG. And this one broke out today, and next week they're reporting earnings. So those are always fun.
I love when stocks break out right before earnings. It's fun.
It's like putting Tito's in a punch bowl.
It's just like, no, it is the absolute worst, because then you have this big dilemma. It's like, do you buy it? You're not going to have enough time to get a big enough cushion. Right. So then you almost have to buy just a little bit of it. And then right before the earnings, you can decide, hey, how much am I up? And do I want to pare that back a little bit? But let's go to the monthly on this one, because this has been a monster for forever.
Yeah.
So when it came out, it came out at a bad time during the bear market. So I had to put a lot of time in. But in 2003, that's where it really started its first model book run and had that massive move up there. And rather than falling apart that time, it just kind of had this constructive phase where it pulled down, and then it had another run up. And you can completely forgive that fall in 2007 to 2009, because everything fell apart. And then, of course, in 16, 17, you had this other run. Now, the reason why we're always looking at these monthly charts is because that's what you want to see, is that the stock has had the ability to be a leader at one point. If you pull up a chart and it's just been sideways or lagging the market forever, why do you want to play, in that playground? You'd rather go with something that's better merchandise. So now let's look at the weekly real quick. And look at the sales growth. It's decelerating a little bit, which is kind of understandable. Because what they do is they have these big giant surgical devices, and it's kind of the old razor and razor blade type of thing, where you buy this $1 million device and then they sell you all the parts for it.
And the device is called the Da Vinci, right, Mike?
The Da Vinci.
Yeah, and now we did an IBD live show earlier this morning, right? So it's been a good day.
You're gonna throw me under the bus. I can. But
you had a great T-shirt, Mike. You had a great T-shirt on.
Yes,
but Da Vinci, right? And you proudly showed it on IBD Live, saying, "Hey, look, this is inspiration. Stock breaking out. I'm wearing my Da Vinci shirt."
Look, it was the dude from The Big Lebowski, and it was a combination with the Da Vinci, whole thing going on. I was so happy because I saw ISRG breaking out. I'm like, I got to put this shirt on. And then, of course, I had some lunch, and I spilled a little bit, so I had to put a different Grateful Dead shirt on. So thank you.
Now, did you switch? You changed during the IBD Live?
No,
Or-
dude,
or-
I had lunch like an hour ago.
No. But you wore the Da
No,
Vinci
I had
shirt.
that on. Yeah, because I saw that it was.
Oh, you saw it was gonna break out,
Yeah,
okay.
that it was going to break out, and I was. It
Okay.
was. It was so I'm like, I got the things that make me happy. I don't know. So,
You
anyways,
make us all happy.
so looking at this, this is not a perfect stock. So let's look at the flaws in it, and that's what you want to do whenever you look at a chart. You want to look at the weekly, look at all the fundamental data. Lots of good things and some bad things. So the estimates for 2020 are horrible at a minus 32. You're going to see that with a ton of stocks because, especially with this product, think about it. It's for elective surgeries or surgeries that, you can kind of put off a lot of times. So, the hospitals are saying, hey, look, hold off on those surgeries, for a few months. And so it's hurting them. So what you really want to see is that it has strong estimates going forward, and it really does for next year. At 48%, that's solid. So this is just kind of a temporary thing. It's almost like you're living on the East Coast, and a hurricane is coming through. Everything is shut down, but then it goes back to normal. And then if you look at the sale or the earnings in the bottom, the problem is it's not super stable on a quarterly basis. You've got some 38 and then 2 and then 14 and 7.
Right.
So that's a little bit of a minor defect. So when you're rating this stock, you're not giving it an A because it has some flaws. So you bring it down to a B, but the fact that we had it on the monthly and it had such a great past, you're still keeping it at a B. Whereas if this had been dogging it for a while, you'd probably put it down to a C. And we always like to rate our stocks that we're trading. So now let's look at the daily chart. And so it does look a little bit wide and loose here, even in the context of what a lot of charts look like with the general market. But think about it. If this stock were to make it up to 700 or 800, that base is going to get compressed and it's not going to look as bad. So this handle area is constructive in that it was able to come down and settle right at the 200-day. So when you're looking at bases, you want to say, is it settling in at logical areas where the big guys and girls would go in there and support it? And this one did. It stopped right there at the 200, and the 50 came through it. So it did exactly what you'd think. Yesterday it had its nice upside reversal, giving you the expectation that this was going to happen today, and then you broke out. You had decent volume. You went over your standard pivot at the 601.21. So you could have been buying it today. But like you said, the earnings are, around the corner. So you have to be careful with it.
Yep, 6 days. So you want to keep an eye on it. Maybe you have a small position going into earnings. That's up to everyone there. But something to keep an eye on. And obviously, we are in earnings season. So just giving that little PSA to everybody. Make sure when your stocks are reporting earnings, and also if you're considering some of these stocks, make sure when they're reporting earnings too. We'll probably have a much better idea of what's gonna what the environment's going to be like over the next few weeks once we hopefully we can survive earnings.
And next time you bring me on, if you bring me back on, because if someone cancels, I will wear my Da Vinci, the dude shirt. If you say the dude,
I don't know if that's enticing enough to bring you back. What else you got?
I'll buy you a beer.
Well, I'll tell you what you can maybe do. Maybe buy me a burrito from Chipotle.
Oh, nice segue. Yeah. Okay.
So second stock, Chipotle, symbol is CMG. And what time frame, Mike, would you like us?
Yeah, let's start at the monthly on this one. And you've got to love this stock because it had, back in 2009, everyone should go back and study the bases in there. And it probably had the most beautiful cup with handle base.
That's true.
That I've ever seen. Like even, the second best would probably be Chrysler in the early 60s, right after the Cuban Missile Crisis. And this would be second of all the bases I've ever seen.
It looked too good to be true. That's what, I bought it out of the breakout like everyone else, but kind of so it was just like, this cannot work. It is just picture perfect. It was on the follow through day. The stock broke out. It was the one stock, massive break. I was like, this can't work. And it worked just like the book.
Yeah, it was one of the, exactly, whenever you see one of those things that it looks that good, you're like, no, they're fooling with us. That can't really be the cup with handle, but it was a cup with handle with a double bottom within it.
Yep.
And go back and study it, and it's a beautiful thing. And
September 1st, 2010.
there you go. And so you had that huge move, and then they did missteps, just like what happened with Netflix at one point when they had their pricing issues. And so companies make mistakes, just like we make mistakes. I mean, you don't make mistakes, I make mistakes, but
all I do is make mistakes.
all you do by having me on. Is that
No, that's the one of the few non-mistakes.
Oh, there you go. So look, it was able, and that was really where it was getting people sick, and I was one of those people. But I've forgiven them. It's okay. They haven't even given me a free burrito. I've asked. It's fine. I was on a cruise.
I think I've only had one, maybe one, or I've gone one or two times since that.
Since
a year and a half ago, and I used to go every day. We would run into each other
at
Chipotle, right?
Yeah, exactly.
Yeah. It's pretty amazing because I just got out of it, and then it was just hard to get back in.
Well, so it's interesting because one of the things that they did that was so smart is they would give out free burrito coupons to try to get people to come back. And so companies can do either silly things and just say, okay, we can't risk, we've already lost so much revenue, we can't lose more by doing some big promotion. But they were smart enough saying, hey, we used to be a habit for people, but because this incident happened, they stopped coming. They wanted those people back, and so they gave out tons of freebies to get people back into that routine of going there on a regular basis. Now let's go to the weekly on this one. They've really done a good job, in my opinion, with the whole coronavirus of making it where if you want, it's a kind of a touchless experience where you can order it on your phone, order it on your app, just walk in, pick up your food, and not even you talk to anyone really. You just see your name there, you pick it up, and you go. And so they've done a great job with that. And you see a lot of millennials and Gen Z's?
Z,
yeah.
Z, yeah.
They're in there as well as the old folks like us. So from a business standpoint, that's really solid. Now, looking at the fundamentals, we have that similar situation with the earnings estimates, but it's even more dramatic than the ISRG with the estimates for next year, that massive recovery. And so that's what you really want to be seeing is, what are the analysts thinking out next year? Forget about this year. This year is dead. But for 2021 and 2022 starts showing up there. And that's at least what people are expecting. We don't know how that's going to play out. So the earnings have kind of fallen off a cliff last quarter, where negative. Normally we wouldn't even consider a stock like that, but this is a unique situation. And what's nice about it on the weekly chart is, it started falling apart during the bear market, but that bottom week had that huge spread closing at the top, and that's a massive sign by the big institutions saying, hey, okay, enough is enough. I want this stock, and I'm going to support it. And then they pushed it up, and since then it's been a rocket ship, straight up,
amazing.
Right?
Yeah, and that really strong move up, and it's formed a beautiful flat base. Broke out of it last week. It's acting really, really well, and they're reporting earnings in 7 days. So if they can survive that, this might be one of those stocks that just continues to crawl up, and it's a nice one to have in your portfolio.
Exactly. I think we have another.
We have another, and it probably shouldn't be a surprise to most who've been watching IBD Live or watching us on our when you're on the podcast with me, Mike. It is.
What stock is this?
It is our favorite.
That's
Tesla.
Right. Huh. I've never seen this one before. Look, this is
maybe the last 5 minutes you haven't seen it.
Yeah,
but
this is our favorite stock. Both of it's my favorite stock, my biggest position. Probably same with you.
Yep.
Yeah. So look, this is not in position. It's way extended. We have earnings, around the corner, just like every other company out there for the most part. But, this is one that, there's a lot of talk on, is this a climax top or isn't it? Now, you never know until after the fact, but what you do is you use history as your guide to try to give you information on, is it or isn't it, or is it more likely to be? And so my opinion is that it's not. And the reason being is it's too soon out of this recent base. So we had the move last year, right? And it was
Right.
sort of running up, had that, it was by far the leader in the market. And it had climax action on that top week. And that was clear that it needed to pause there for a while. And I unfortunately was trying to wait for it to do some other stuff before I sold it. So, one thing that talking with Chris Gessel of IBD Live, and, he's pretty much one of the kings of IBD. He started talking about, when you're in a situation like that of actually hedging your position by buying some puts, which is something that Bill O'Neill was never a fan of. He would just say, you either, raise cash by selling some, or you don't play both sides. And it was very eye-opening, of Chris's take on that. Is when you're in a position like that, if you're trying to wait for it to, decisively break the 10-week, why not just buy some puts? So in a situation like that, you could do that. You could do the same thing up here. If you wanted to, if you weren't sure, you could be buying some puts just to hedge your.
I mean, it's only 46.8% above the 10-week, like right now.
Yeah, so it's way up there. So, and you're going into earnings. So if you've got a big cushion, you want to protect it, you could certainly do that. Now, the options aren't the cheapest things in the world. The implied vol is off the charts. But let's go back in history, because lots of times you use other stocks for to give you a guide. But let's go back and see what this stock did before. Let's do a change date to 5/7/2013, May 7th, 2013. Okay, so this was in, let's go to a weekly, just so everybody, and I know most people probably listen to your podcast while they're working out or doing something really cool or driving, or when I'm on trying to sleep, it's like, oh, I'm having trouble sleeping. Let's put the Webster podcast on. So with this, whenever I'm on, you probably want to actually watch it so you can watch the charts and go through them.
Investors.com/podcast.
Yes. And so this one was soon out of that basing area, kind of like what we're in the same position where we are now. And that's climax action, but it's not a climax top. So climax action is when you get that parabolic type of move, but it's early into your base. Climax top is when it happens after you've been running for a long time. And Bill would always say at least 18 weeks out of your recent base, unless it's a late stage base. And we're too soon for that. So let's go to the daily on this. And you can really see that has a lot of similarities to what we're going through right now, right? Really extended. You have this big spread closing at the bottom. You assume this stock is done for, a while. Now let's go out a week. Let's go out to 5/14/2013.
Wow.
And look what happened. So you have this.
The other week looks tiny. The other day looks tiny.
Yeah. And so that's what I was talking about with the ISRG, how it looked so uncompressed. And then when you go out, it compresses the chart, makes it look tighter. So with this, what seemed high wasn't. And so you've got to say, what could I use to keep me in a stock like that? And what you can do is use that 21 day. And if you haven't broken the 21 day, you're trying to sit on your hands. Now, if you've gotten carried away and you're up to your eyeballs in stock and it's up there like this, you can take some off the table, but you want to keep some, you want to keep a core position, because this is still, let's toggle back to the weekly. This is still early in that move. This is not late in that move. Now let's go out just a little bit more. We have two more dates, 5/23, and we'll go to a daily. All right, so at this point, you've come down. You just bounce off your 10-day, which, and you have this big outside day, meaning your spread is bigger than your prior day. In fact, your prior couple days. And so now your expectation is, hey, we're off to the races at this point, and it almost is in the vein of a high tide flag. It isn't exactly a high tide flag because it isn't long enough there, the flag portion, but you have that feeling like it's moved up.
For sure.
Now it's gone sideways, and your eye is really on that 21 day. So let's go out pretty much to the top. We'll go out to November 6th, 2014, just in the interest of time. November 6th, 2014.
All right.
Okay, so this is after or maybe it should have been 2013. I'm sorry, I gave you the wrong date. Okay, so this is after that bulk of that move is done. And you can see that during that time, it only tested the 21 day one time, and that where it went down.
This is the Goldman Sachs. I think was that the Goldman Sachs where they downgraded it?
Probably. They're so good. I have so much faith in their work. So anyways, that's
yeah. I mean, they nearly killed me because I had a big position at that, and then it dropped like 15% in like one day, and I think I did pass out for a while. Yes, exactly.
Yeah, we love analysts. So anyways, it had that horrible couple days, and you would have had to have sold some, right? You can't just go down. You can't go down with the ship because that's how they look before they go down to $50. So you can't.
Exactly.
And Bill did that with Qualcomm back in 98, 99. There was a time where it came down hard. I don't know if it was a downgrade or not, and then it gapped up. And I'd heard, I wasn't working with them at the time. That started in late 99, early 2000, and I'd heard through the grapevine he was really upset. But he went in and on the gap up just loaded back up because it was a game changer. And that's the same thing that you want to do here. Be flexible. Don't care that you just sold a bunch the day before, and you had to do that. Then you have to go back in and you buy it. And it held the 21 day until the top, a couple days off the top. Then you started breaking below it. That's your character change. That's where you're looking out. And then it wasn't the same from then on. Really, it was a
I think this is where I
stock.
finally closed out the position. Or maybe,
good for you, man. Good for you. That was. So let's go to the current. Now that everyone has this in mind, let's go to the current chart. And you should really go back and do this and go through. Even every other day or every few days, stop on it. So now you look at this and you go, wow, I have this picture in my head that this could go a lot higher. What everyone thinks is so high at 1,500 could just be a little small blip along the way or not. We don't know.
And it can happen.
You at least have that in your mind as a possibility. Mm-hmm. So with me, how I've been treating this lately is right before we went through 1,000. When you're in a stock a lot, you can get a kind of a sense of a rhythm of the stock, and it felt like it was going to just launch at that point. And you just put enough of the pieces together that it held in tight and was relatively tight. And I think we were talking about this on IBD Live too, that the time frame is a volatile stock, but it was holding in tighter than most other other stocks, of the crazy, high growth stocks. And then it's set up, and there are times where you just got to put a bunch of chips out, and you don't do it very often because you can get burned. But I said, if it goes below the low of that day, if you can point to it the day before it went through 1,000, the blue day, that day,
on the 29th,
right? On that day. So as it was approaching, put a bunch of chips out there in a big way. And then, but on Monday, as it, let's go to the intraday real quick. When you had a gap up like that then faded. Once that started filling that gap, I had to start lightening up because at that point, then you have massive amount of risk that it could do what it did in 2013, where it could have come into 1,200 or even lower. And so if you're going to do one of those moves where you put a bunch of chips out there, you've got to be smart enough to pull them off. So I started putting a few back today, but really it's back down to a manageable position because we got earnings around the corner. And even though I think the stock could go a lot higher, and I think the floor is really that 21 day. Look at where is that 21 day at?
It's a long ways down. 23.9%.
Yeah. So that's a lot to give up. So that's why a lot of those chips have come back off.
Yeah.
So this is a very controversial stock, and people either love it or hate it, and they either think Elon Musk is the brightest guy who's ever lived, like I do, and I think you at least think he's super smart.
Yep.
Or you've got the Eds of the world to think a little differently. We gotta have Ed on with us.
We do. We'll have to have that showdown. But of course, the showdown is every day almost on IBD Live. So
yeah.
But those are always
should we bring out the boxing gloves that you and I did at one time?
Yeah, I think so. For you and Ed, I think that would be a great thing.
Yeah. Well, thanks for having me, bud. I appreciate it.
And so there are a few ideas that are worth adding to your watch list. And Mike, once again, thanks for joining us for the third segment.
That's it, man. I'm not going to say anything else. I'm not going to Do you want to?
I was stunned there that you didn't say anything.
Hey, I can't wait to be back, and then at that point we'll talk about the beautiful artwork that my daughter painted for me behind me.
That's awesome.
Very, very happy with that stuff. So thanks again, bud. Be careful out there.
Yeah. And also thanks once again to Kerim Derhalli for joining us on the first two segments. Next week, we are going to have Andrew Chanin on the show. And Andrew is the co-founder of Procure AM. And we're going to talk about their out-of-the-world ETF that's centered around space and has a ticker symbol of UFO.
That's cool. Are you serious? Cool? UFO?
And he is a really cool guy. So you definitely want to. He's done a lot of things. He's a young guy, and you know what? He actually, I'll give you a little tidbit here, Mike. He actually was the one who created Hack.
No way. That's the coolest symbol.
Yeah.
He needs to do like an Area 51 somehow.
That's a good idea too. We'll have to suggest that next week. So that's it for this week on Investing with IBD. And I'm Arusha Paris, and thanks for listening.